Good afternoon and welcome to APW Market Wrap number 225. As you can see, we're in our new film offices. They're pretty schwiz as we are investing in our communications with our clients, because it's important that we get the message out there as to what's going on in the marketplace. And the more we can educate people and try and help, the more we can help people make buying decisions and hopefully make the correct buying decisions. So this is 225, Stuart Williamson. And firstly, I just want to cover a couple of comments from last week's wrap and some real charmers. I have one gentleman here, I think it's a gentleman. If you landlords are really running a business like you pretend to, what's wrong with meeting the regulations? But obviously it's natural to feel a little bit concerned that if you have a problem tenant who insists on not paying the rent or abusing your hospitality, that you can get them out. I was speaking to a gentleman last week in Dubai, I think, and he had a tenant who was actually a housing officer for his local council, and once he'd moved in, he just didn't pay the rent, and he knew every trick and turn to try and avoid paying that rent. So you do get people who are malicious in their behaviour. So hence why you want to make sure that you potentially can get a tenant out if need be. Another comment being, so the private sector will create a revolution. What a nonsense. Building properties abroad is more profitable. Again, it's possible. Having a well-balanced portfolio is always a good idea. Whereabouts abroad? Well, Bali, Lombok perhaps. When you can't own it yourself, you have to own it with a local partner. Perhaps not so good, but it is an idea to have a multinational portfolio and try and invest in different countries, different currency risks, different parts of the property cycle. So yeah, I'd agree. I don't know about the revolution though. Won't a shortage of rental properties drive prices up? Lots of people can't buy houses either due to lack of funds, poor credit, low salary. So how do those who can't buy cope with the housing shortage? Landlords exiting the market can't be good for renters. No, absolutely not. There needs to be more government promotion of helping people who can't get onto the housing ladder to get on. And as I said, I think a couple of wraps ago, if you could perhaps go on people's credit rating as far as paying their rent. Have they paid their rent on time over the last 2 years? Perhaps that helps them get on the ladder. Just because they don't have a credit rating that is under the standard guidelines, there must be other ways of doing it. Also, getting people into joint owned social housing would work. Then that's a good concept that I've seen kicked around. So yeah, we do need to try and help first-time buyers get on the market. And we're going to talk about a little bit about that in the wrap now. So the wrap is property boom on the horizon. The signs are there. I'm going to go through that shortly. But first, I just wanted to cover some notes on the build-to-rent sector. The UK's state-backed pension scheme has agreed to tie up with Insurance Legal and General and a Dutch pension provider, PGGM, to invest up to 1 billion in build-to-rent properties. Now, I know L&G are already investing a lot more than that, I think up to 3 billion, but it's a new thing and it's a joint venture with the UK's pension scheme, which is actually very good, and it's great that the Labour Party have put this into action. I don't know why the Conservatives didn't do it, but basically it's a case of using in-house funds that people are putting into pensions to create low-risk investments. Elizabeth Fernando, the Chief Investment Officer at Nest, the state-backed UK workplace pension scheme, with assets of 443 billion, and 30 million savers, so a huge fund. She basically said, we can see there's a critical shortage in the housing supply, coupled with increasing demand for high-quality rental homes. And so what the build-to-rent is that these people will just build blocks that are purely for rental with a common manager, and they'll be high quality. So it's very much what has happened, as I mentioned before, in the US and in Europe. It's a good build-to-rent concept. So that's what they're doing, and that's a great step forward. Now, what are things that normally herald property booms? Well, if we look historically, then one of the first factors is aggressive interest rate cutting. Now, yesterday, Andrew Bailey, who's the Bank of England governor, described the risk of a Mideast oil shock as very serious. And he felt that it was putting space there for us to, or him, not us, I don't get involved, for him to potentially cut rates quite aggressively. He said the Bank of England is monitoring the Middle East crisis amid fears that a worsening conflict between Iran and Israel will make it impossible to stabilise oil prices and will leave the global economy at risk a la the 1970s energy shock. He said they were monitoring it extremely closely, and there were limits that could be done to actually keep the cost of crude oil from rising if things got really bad. He basically said in the Guardian newspaper, in a quite a large interview covering lots of different areas, but we'll focus just on this one, he held out the prospect of bank becoming a bit more aggressive, that's a quote from him, in cutting interest rates, provided the news on inflation continued to be good. Shortly after the interview was published online, the pound actually fell to a 3-week low as traders reacted to the hints of a more activist approach to reducing the cost of borrowing. So the market is taking heed of this. Bailey said the economy has proven more resilient than he feared 2 years ago, or even a year ago. I think the economy, he said, has come through the shocks of the last 5 years better than many of us feared, so there's a base out there to develop on. He said the government is right to focus on how to encourage capital investment, but there's a clear need in terms of infrastructure development. But we've got 3 structural issues that need to be taken care of. Aging population, which is much of the developed world, demands for increasing defence spending, and the third is dealing with climate change, which is really interesting coming from Bank of England. He thought they were very much focused on, facts and figures, money, not looking at the bigger picture, but it does go to show that they do look at the bigger picture. So inflation is measured by the Consumer Price Index, currently standing at 2.2%, which is just above the 2% target that the Bank of England wants. Bailey said he was encouraged by the fact that living pressures had not been persistent, and there was a good chance of the bank becoming more activist in its approach to cutting interest rates, which he said currently at 5% would need to come down further. So that's very positive. Potentially, instead of it just being in November we have a cut and then another early next year to get us down to 4.5%, let's say 4%, perhaps, a lot more aggressive, because they need to stimulate businesses to put money into the economy if there's a time of oil crisis. So that's factor number 1. And factor 2, which again we saw in the mid-80s, Nationwide is now allowing first-time buyers to borrow 6 times their earnings. And really, that's a back to the future moment, because that's exactly what happened in the 80s. Exactly, interest rates were cut very strongly and other factors came into play. So Britain's biggest building society is set to let first-time buyers borrow up to 6 times their earnings in what's been labelled a game-changing move that ramps up the mortgage price war. Weeks after it was announced that Halifax and Lloyds would allow new buyers to take out loans up to 5.5 times their household income, Nationwide says it's going to 6. It's also cutting the mortgage rates, and it's cut the mortgage rates down to below 4% on many loans, and it's increasing the size of the loans you can take out. Previously, it was £500,000 to get a 90% loan to value. They're now saying you can do a 90% loan to value at £750,000. So that's an easing of their lending criteria. And it's still within the stress tests that the Bank of England is required to occur when building societies and banks are looking at lenders. Basically, there's a mortgage price war going on at the moment with different lenders trying to undercut each other and grab the market, because when the market does take off, they want to be well placed to be there. And if interest rates are cut, then we will see more of this going on. Basically, the Nationwide's move is, it's not going to there for everyone, but the point is, traditionally, you've only been able to borrow, say, 4 to 4.5 times your actual earnings capacity. Being more aggressive is going to let people get onto the market, and it's going to help the market move. Already we have a positive sentiment because people are seeing that, with the exception of the top end of the market, I mean, with the upcoming budget, the top end of the market has been selling quite quickly. That's over £2 million prime residences, because people are frightened of this potential capital gains tax issue coming in and being a lot higher. But I would say, have a caveat on that, in that in dot-com bubble, things were going to go wrong. 2008 housing crisis, it was all going to go wrong. COVID, it was all going to go wrong. We all look at the micro too much. And just because there's a budget doesn't mean you need to run out and throw the baby out with the bathwater. It's a long-term game, and so stick with it. What these mortgage lenders are doing is increasing the amount of money that can be got for a loan to allow more people to upgrade at a lower price, the same way that they're increasing mortgage terms up to 40 years. The Nationwide has it's a department, so to speak, that they call their Helping Hand section. It's an initiative, and they're trying to help people get onto the ladder, move up the ladder, so they're not stuck. And I think that's a very positive thing. The build to rent concept that Nest and the Labour government have come up with is also very positive. If interest rates are cut and the economy can stand it, that's a very positive thing. So these are all positive outlooks in the UK property market. Again, it's all about caveat emptor, buyer beware, watch out where you're buying, make sure you are buying something that is in the PIE's location. Population growth, infrastructure growth, employment growth. That's what we believe is a good idea. So that is Market Wrap 225 for this week. Thank you very much for listening. Do subscribe if you get a chance. Do send it on to people who might like it. And hope to see you again next week. Cheerio.